Please like, share, and subscribe. Wishing you happiness and good luck every day.
So, what if the secret to getting rich wasn't actually on Wall Street, but maybe on some dusty road in the middle of nowhere? Well, today we're diving into the brilliant and, let's be honest, often controversial mind of the legendary investor Jim Rogers. We're going to unpack the big ideas from his book Street Smarts, which is this amazing mix of a travel journal and an investment masterclass. Right out of the gate, Rogers does not pull any punches. He hits us with this bold statement, and it really frames his whole philosophy around one massive idea. The world's center of gravity is shifting, and you better be ready to shift with it. And this is the book we're talking about. Look, this isn't some book that was born from spreadsheets and sterile boardrooms. Nope, this was written on the road, after he literally drove around the entire globe twice, just to see how the world really works. So, you gotta ask, how does a kid from rural Alabama end up becoming a global investing icon? Well, it all kicks off with this lifelong mission to ignore the noise, ignore the headlines, and find the real story for himself. It actually started in his backyard in Alabama. As a kid, he's digging for fishing bait, and his cousin says to him, "You know, if we keep digging, we'll end up in China." That simple little moment planted a huge seed, this powerful curiosity about what was really on the other side of the planet. And that curiosity, it basically became his life's guiding principle. For Rogers, you just can't understand the world from an armchair. You have to get out there. You have to see it, touch it, talk to the people who are living it. That, for him, is the only kind of research that actually matters. His first major eye-opener didn't come from Wall Street at all. It came when he was studying at Oxford back in the 60s, where he got a front-row seat to the slow, painful decay of a once unstoppable global power. This ancient Greek idea became his investing mantra. Rogers realized that the real secret isn't some stock-picking formula that works forever. No way. The secret is understanding that nothing lasts forever and learning how to spot these massive historical shifts before everyone else catches on. I mean, just look at this timeline. The fall was shockingly fast. In a single generation, Britain went from being the world's undisputed superpower in 1918 to needing a bailout from the IMF by 1976. For Rogers, watching this happen in real time wasn't some boring history lesson. It was a live demonstration of just how quickly empires can crumble. So he saw that exact same cycle starting to play out all over again. He saw how global power shifted from London in the 19th century to New York, and he became absolutely convinced the 21st century was going to belong to Asia. And, this wasn't just some theory for him. It's why he literally packed up his entire family and his fortune and moved to Singapore. Now, this deep understanding of history, it became his secret weapon in the markets. Rogers built his name and his fortune by consistently, and I mean consistently, betting against the crowd. This is a perfect example. He once told a woman at a party that he was doing great in a terrible market because he was short. She just looked at his 5'5" frame and was completely confused. It's a funny story, but it perfectly captures just how far outside the mainstream his thinking really was. So what in the world is short selling? Well, it's just flipping the classic formula on its head. Instead of buy low, sell high, you sell high first, and then you buy it back low later. It's how you can actually make a profit when markets are crashing and pretty much everyone else is losing their shirts. But being a contrarian, it's dangerous. Early in his career, Rogers shorted 6 companies that he knew were going to fail. And you know what? He was right. Every single one of them eventually went bankrupt. But he was too early. The market went against him first, and he got completely wiped out. A really painful but absolutely vital lesson. So, after decades of huge wins, tough losses, and globe-trotting adventures, what has he actually learned? Let's break down the core rules from his personal investing playbook. Because according to Rogers, it is definitely not by doing what everyone else is telling you to do. In fact, most of the time, it's the exact opposite. It really all boils down to 2 things, patience and knowledge. He says you should never, ever invest in something you don't understand inside and out. And get this, most of the time, the smartest thing you can do is absolutely nothing. Just sit there and wait until an opportunity is so obvious and so cheap, it literally feels like you're just bending over and picking up money that somebody left in a corner. And here it is, his most radical, most controversial piece of advice. You know how Wall Street is always preaching diversification, don't put all your eggs in one basket? Rogers calls that a guarantee of mediocrity. Real wealth, he argues, comes from finding just one or two brilliant ideas in your entire lifetime and betting big. Yeah, it's incredibly risky, but he insists that's how true fortunes are made. So where does this ultimate contrarian see money just lying in the corner today? His answer might really surprise you. It's not in tech. It's not in crypto. It's not even in finance. It's in the ground. I mean, the numbers here tell a really scary story. The average farmer in the US is nearly 60 years old. In Japan, it's almost 70. An entire generation is retiring, and almost nobody is lining up to replace them. Rogers looks at this and sees a massive crisis on the horizon. This quote just says it all, doesn't it? The world's brightest young minds are all flocking to finance and marketing, while the industry that, actually feeds us is being almost completely ignored. For a contrarian like Rogers, this massive imbalance, well, it screams opportunity. And this all leads him to his final, really bold prediction. He believes we're at the very beginning of another one of those great historical shifts, a move away from the people who just shuffle money around and toward the people who produce real, tangible things. He is convinced the next generation of millionaires won't be on Wall Street. They'll be driving a tractor, or maybe a Lamborghini to their tractor. So in the end, Rogers' whole philosophy isn't just about stocks or commodities. It's about developing a truly independent mind. It's about learning from the past and having the courage to stand completely alone when the whole world thinks you're crazy, but you know you're right. So the final question isn't really about stocks or farming. It's about looking at your own world through a lens like Rogers. If he's right, and the biggest opportunities are always found inside the biggest changes, then the only question that really matters is this. Which way are the winds of change blowing for you? And what's the one big thing that everybody else seems to be missing?
All right, today we're diving into the pretty incredible story of Jim Rogers. You're talking about a legendary investor who went from, believe it or not, the backwoods of Alabama all the way to the top of Asian finance. And what's really wild is how one little thing he heard as a kid basically shaped this entire global investment philosophy. A philosophy that, frankly, is shaking up everything we thought we knew about Western economic power.
So where does it all start? Well, you have to picture this. He's just an 8-year-old kid in Demopolis, Alabama, digging for fishing bait, and his cousin Wade says to him, if we keep digging, we'll end up in China. Now, it sounds like something any kid would say, right? Just a total throwaway line. But for Rogers, that one little idea that China was literally on the other side of the world, it planted a seed. It ended up becoming this huge metaphor for his entire life.
And here's the crazy part. That childhood curiosity, it totally came full circle. Now, obviously, the path he took was a bit more complicated than just digging through the dirt, but Rogers ended up, well, exactly where his cousins said he would. Today, he lives in Singapore, right on China's doorstep. His kids, they speak fluent Mandarin. So yeah, this is a story about digging, but a different kind of digging. It's about a relentless, lifelong quest to get to the truth, to unearth the real story of how the world works. Okay, so before he could start digging into the world's secrets, he had to survive a place that, to him, felt just as foreign as China, the Ivy League. And it was right there, feeling like a total outsider, that he developed the one core principle that would basically define his entire career. I mean, just getting into Yale was a total shock, and the money situation, it was stark. His dad had already paid a $50 acceptance fee to another school. Now, $50 might not sound like much today, but back in 1960, that was a ton of money. And the fact that they had to struggle just to get that $50 back, man, it really shows you what a huge, monumental deal this was for a family from a small town in Alabama. So, you'd think he'd be thrilled, right? Popping champagne? Not at all. He was absolutely terrified. He was convinced they'd made a mistake, that he was a total imposter. He kept thinking, oh man, these guys think I'm smart. They think I actually know something. And that feeling, that feeling of being completely in over his head, it would go on to shape his entire approach to, well, everything.
So what do you do when you feel that kind of fear? How do you overcome it? Well, for Rogers, the answer was just this simple, but totally relentless: discipline. You see, his classmates might be like, okay, this test is worth about 5 hours of studying. But Rogers, that's not how he worked. His approach was, you study until you know the material cold, and then you study some more just to be sure. It was literally the only way he knew how to combat that feeling of always being one step behind.
And that right there,
brings us to his core philosophy. For Jim Rogers, success was never about being the smartest guy in the room. In fact, he'd seen plenty of those smartest guys fail, and fail hard. He believed it all boiled down to just one thing: pure, relentless persistence. See, passion is great, and raw intelligence is great, but they can burn out. Dogged determination, that's what gets you across the finish line every single time.
All right, so now he's armed with this insane work ethic, and then a summer job comes along that completely changes the course of his life. He kind of just stumbles into a gig on Wall Street, and what he discovers there, it was nothing short of a revelation.
The change in him was just staggering. I mean, he walked into that summer job in 1964 literally not knowing the difference between a stock and a bond. He admitted it, but by the time he walked out, he'd figured out this incredibly profound truth that the world isn't just a bunch of random, separate things happening. No, it's all one giant, interconnected machine.
And for the first time, it all just clicked. He saw these invisible lines connecting global politics to your everyday life. A revolution happening way down in Chile, that wasn't just some story on the evening news. He realized it could actually ripple across the entire global economy and change the price of copper, which changes the price of electricity, which could even change the cost of building a house in, say, Toledo, Ohio. All of a sudden, history wasn't this dusty theoretical thing anymore. It had real, practical, financial consequences.
You know, he got some pretty blunt advice that summer, too. A senior partner basically pulled him aside and told him to forget about business school. He said, "Look, kid, come down here and sell soybean short. Just once. You'll learn more about how markets really work than you will wasting 2 years in some classroom." It was this perfect lesson in street smarts over book smarts, practical knowledge over academic theory.
And that was his big epiphany. The light bulb just went off. Wall Street wasn't just about making money. No. This was a place that would actually pay him for his natural curiosity, for his love of history, for his obsession with figuring out how the world really works. He realized he could get paid, and paid really well, to do the one thing he was already wired to do: explore.
So, you see, this personal aha moment quickly grew into something much, much bigger. It became this grand theory about the world itself. He started taking that interconnected view of his and applying it not just to single stock trades, but to the huge, sweeping changes of history.
His entire investment philosophy really boils down to this piece of ancient Greek wisdom from Heraclitus. Nothing endures but change. I mean, think about it. The world is never standing still. And Rogers figured out that if you want to win in the markets, the single most important skill you can have is the ability to see that change coming, to figure out which way the river of history is flowing before anybody else does.
And Rogers argues that this isn't random, that global power and money move in these really predictable cycles. He lays it out like this. If you were a smart, ambitious person in the 19th century, where did you go? London. In the 20th century, you had to be in New York. And his big call, if you're smart and ambitious in the 21st century, you need to be in Asia. For him, this isn't some wild guess. It's a clear pattern that just keeps repeating itself throughout history.
But that's not the only massive shift he's calling. He says that for decades, the people in charge have been what he calls the money shufflers. The financiers in London and New York who just move capital from one place to another. He argues their time is coming to an end. The future, he says, belongs to the producers, the people who make real, tangible stuff, the farmers, the miners, the folks providing energy. In his view, places like Wall Street, they're on their way to becoming financial backwaters once again.
Now look, when you make predictions this bold, you're going to get called an alarmist, a doomsayer. It just comes with the territory. But for Rogers, this isn't about scaring people. It's about seeing history clearly for what it is and understanding that it presents us all with a choice.
And believe me, he does not pull any punches when it comes to the consequences. He points to these staggering debt loads we have and warns that the institutions we think are permanent, the big investment banks, even elite universities like Harvard or Princeton, are way more fragile than we think. Think about it. When Bear Stearns and Lehman Brothers collapsed in 2008, most people saw that as a once-in-a-lifetime crisis. Rogers, he saw it as a preview, just a taste of the kind of upheaval that's still to come. So this really brings us to the central question, doesn't it? People have started calling him a modern-day Cassandra. You know the story, the princess from Greek mythology who was cursed to tell true prophecies, but no one would ever believe her. So is that what he is? Is he just an alarmist screaming about doom and gloom? Or is he a student of history who's spotting a familiar pattern that pretty much everyone else is completely missing?
But you see, from Jim Rogers' point of view, none of this is shocking. It's not unprecedented. He looks at these massive global shifts not as some terrifying crisis, but as, well, business as usual. For him, it's just history doing what history always does, turning the page and starting the next chapter.
And that leaves us with a pretty provocative final thought, doesn't it? It's always easy to dismiss the person shouting a warning. But Rogers would remind us of one crucial thing about Cassandra. Yeah, she was ignored, she was ridiculed for her prophecies, but she is the ultimate vindication of history, because in the end, she was right. And the question he leaves hanging in the air for all of us is, will he be too?
You know, sometimes the biggest, most incredible opportunities are just hiding in plain sight. They're just waiting for someone to look at the world a little bit differently. Well, this is the story of one of those people, the legendary investor Jim Rogers, who saw a massive future in farm fields when literally everyone else was glued to their stock tickers. It's a heck of a lesson in how to bet against the crowd. In this quote right here, this is the key to the entire story. It's this timeless, almost universal lesson from history that great powers, well, they eventually crumble under their own weight. This one idea sets the stage for a monumental shift in global power, a shift that a young American was about to see firsthand. The empire we're talking about, of course, was Great Britain. And the scene for this incredible story, this transfer of wealth and power, was set right in the middle of the 20th century, just as the cracks in that mighty empire were really starting to show. What's just staggering here is how fast it all happened. I mean, think about it. In 1918, Britain is on top of the world, the richest, most powerful country, hands down. But just a few decades later, its currency is in a total crisis. It can't even project military power east of Suez anymore. And then, by 1976, the unthinkable happens. The former empire needs a bailout from the IMF. It's an absolutely astonishingly fast fall from grace. So arriving right smack in the middle of this national decay in 1964 was a young, very observant American student. His name? Jim Rogers. And he was there to study at Oxford. Now, at the time, the British government was insisting, absolutely insisting, that one British pound was worth $2.80. But this number? It was pure fantasy. The government was desperately trying to prop up a currency that the real world knew was way, way weaker, mainly because the British economy itself was crumbling. The official story just did not match reality. Rogers saw this disconnect so clearly that he literally never carried more than a few shillings in his pocket. Why? Because he was absolutely convinced the currency was going to be devalued, and he did not want to be caught holding it when the government finally had to admit the truth. Even then, he was learning to see what everyone else was choosing to ignore. And you know, it wasn't just the economy that felt a bit hollowed out. As an outsider, his personal integrity got tested pretty early on. A rowing coach actually tried to get a 4-figure bribe from his dad for a spot on the team. Rogers was just floored. He refused to play that crooked game. And in the end, his integrity won. The coach got fired, and Rogers went on to coax the team to victory. Okay, now let's jump forward. Way forward. Nearly 40 years, in fact. It's 2010, and Rogers goes back to Oxford to give a lecture. And the world he finds, well, it has been completely turned upside down. And wow, this just says it all, doesn't it? Back in the 1960s, the best and brightest kids went into public service or academia. Finance, the city, as they called it, that was seen as a backwater, a place you sent the less capable sons of the rich. But by 2010, oh my, every single student wanted to be an investment banker. The backwater had become the main event. So, into this finance-obsessed environment, Rogers was about to drop an absolute bombshell. The students were hanging on his every word, just desperate for the secret to his success. I mean, this was the million-dollar question, right? The question on every single student's mind. How do we get rich like you? They were expecting him to talk about stocks, bonds, maybe some secret hedge fund strategy, the usual path to wealth. Can you just imagine the pin-drop silence in that room? To a packed house of aspiring investment bankers, he basically declares that their chosen field is finished. The future, he told them, wasn't on Wall Street. It wasn't in the city of London. Nope. It was out in a field, on a tractor. So, and this is the crucial point, this wasn't just some wild guess. Not at all. It was based on cold, hard facts. He saw that the world's farmers were getting old, with basically no one to replace them. Food supplies were getting dangerously low, and our educational priorities, they were completely backward. More kids studying PR than agriculture? The entire system was screaming that a massive shortage was coming. And he just crystallized his whole prediction with this unforgettable image, a complete and total reversal of fortunes, where the people who produce real things, food, would become wealthy, while the people shuffling paper would struggle. What a radical idea to drop in that room. But see, his advice was never really just about agriculture. The deeper lesson, the real secret sauce, was about how to think, how to develop a mindset that lets you spot these huge shifts before everybody else does. So when the students, probably a little stunned, pushed him on what they should really study to be successful, his answer wasn't finance or economics, it was philosophy and history. And here's the real insight, the magic behind it all. Philosophy, it trains you to question the popular story, to be skeptical when everybody agrees on something. And history, well, history shows you why that skepticism is so incredibly important. It teaches you that everything, industries, empires, popular ideas, they all move in cycles. The thing everyone is rushing towards today is very often the thing that's going to collapse tomorrow. And understanding those cycles is how you see the next big thing coming. And that brings us right to the final, crucial question for all of us. Back in 2010, the conventional wisdom for Oxford's best and brightest was, go into finance. Rogers told them it was over. So, what's our conventional wisdom today, and which part of it is about to get turned completely upside down? So how does an investor pull off a 4,200% return in just one decade, while the rest of the market barely scrapes by with 47%? Well, it's definitely not about following the crowd. It's about doing the exact opposite. Today, we're diving into the incredible story of Jim Rogers, an investor who made an absolute fortune by betting against the world. You know, it's easy to look at Jim Rogers' success and just call it luck. But as we're about to see, his entire story is a masterclass in this very quote. His massive wins weren't just happy accidents. They were the direct result of just relentless curiosity and some seriously deep first-hand research. So where does this all begin? Well, not in some fancy business school, but actually in the U.S. Army. After his 2-year military stint, Rogers was ready for his next big challenge: Wall Street. The only problem, his timing could not have been worse. Yeah, he didn't exactly walk into a roaring bull market. It was the complete opposite. The Dow collapsed in 1970, and it was the worst market crash since the Great Depression of the 1930s. For most investors, it was a time of pure chaos and despair. But see, Rogers wasn't like most investors. While everyone else was hitting the panic button, he was energized. He saw all this constant change not as a threat, but as this endlessly fascinating puzzle that he just had to solve. For him, it was a game, and he absolutely loved it. Now, this unique perspective wasn't just some personality quirk. It was the foundation of a really powerful investment philosophy. So let's break down the core principles that guided his every single move. It really all boiled down to these 3 keys. First, you have to be insatiably curious about how the world works. Turn over every single rock. Second, be deeply skeptical. Question everything you're told, by governments, by companies, by the so-called experts. And third, and this is the big one, do your own homework. And this really gets to the heart of it. His core belief was simple. Real success wasn't about getting secret tips or following the herd. It was about proving everything for yourself, digging into every source, and coming to your own conclusions, totally independent of the crowd. Okay, so with this mindset locked in, Rogers was about to make a move that would completely change Wall Street forever. He teamed up with another investor who shared his global outlook, a guy named George Soros, and together they created something radically new. The quantum fund they launched was unlike anything else at the time. I mean, while most investors were stuck looking only at U.S. stocks, they went global. They used these aggressive tools like selling short, which is basically betting a stock will go down, and leverage, or borrowing money, to make their bets even bigger. They were always looking for opportunities in markets everyone else was too scared or too lazy to even look at. Now, they did all this through a vehicle called a hedge fund. What is that exactly? Well, to put it simply, it's a type of private fund that has the flexibility to make money whether the market is going up or down, because it can use tools that a normal mutual fund just can't touch. Think of it this way. A typical mutual fund just buys stocks and hopes they'll go up. A hedge fund, on the other hand, can also bet that a stock will go down. It can borrow money to make its bets bigger. This super flexible structure gave Rogers and Soros the freedom and, frankly, the firepower to act on all of their contrarian ideas. So, with the right mindset and the right vehicle, how do they actually put this into practice? Let's look at two classic examples of Rogers turning over rocks and finding gold where absolutely no one else was looking. This first investigation started with a really simple, almost childlike question. Rogers remembered seeing oil fields in Texas as a kid, where these big companies were just burning off natural gas into the air. So in the 1970s, he started asking, why? Why were they just burning free money? So he did his homework, and it uncovered the truth. Government price caps made it unprofitable to actually sell the natural gas, so companies were just letting their reserves run down, and the number of drilling rigs had been falling for 15 straight years. He realized a huge energy shortage was coming, and nobody was talking about it. And of course, when the energy crisis finally hit and their investments went through the roof, a fellow investor just dismissed it all with this comment. He couldn't see the years of research that went into it. All he could see was the quote-unquote lucky outcome. This just perfectly captures how conventional wisdom totally misunderstands contrarian success. All right, the next big opportunity started not with some boring financial report, but with a headline from the 1973 Arab-Israeli War. Rogers was baffled. He's thinking, how on earth could Egypt be shooting down Israel's far superior air force? His curiosity was officially piqued. So he started digging. He's jumping on planes, visiting defense contractors, talking to people in Washington, and the answer he found was a total game changer. The Egyptians were using this sophisticated electronic warfare technology that had been supplied by the Soviets. And here is the absolutely incredible part. At the time, one of the key U.S. companies making this exact kind of technology, Lockheed, was in bankruptcy. Its stock was trading for just $2 a share. The market thought it was completely worthless. Can you believe this? Rogers explained his investment idea at a dinner for these so-called hotshot investors, and he was openly mocked for buying a bankrupt company. But he stuck to his research, and over the next few years, Lockheed's stock went up 100 times. What a powerful lesson in trusting your own work, especially when you feel like you're all alone. Now, these weren't just isolated wins. They were part of a consistent strategy of betting against the crowd that led to one of the most incredible investment track records in history. I mean, their entire approach followed this clear pattern. When everyone was buying up the popular Nifty 50 blue-chip stocks, they shorted them. While everyone else ignored foreign markets, they invested globally. And when the public piled into gold in 1980, they bet against it at the absolute peak. And here is the result of that decade of contrarian thinking. While the S&P 500 returned a pretty meager 47%, about what you'd get in a savings account back then, the quantum fund returned an astonishing 4,200%. The numbers really do speak for themselves. So we end up right back where we began, but now the meaning is crystal clear. That 4,200%, it wasn't luck. It was the direct payoff for being curious, for being skeptical, and for doing the homework that nobody else was willing to do. And this brings us to the final, crucial question. Jim Rogers' story is so much more than just history. It's a mindset. It challenges all of us to look around, to question the popular narrative, and to ask ourselves, what's the one thing that everyone believes to be true that just might be completely wrong? So how do you actually make money when the market is tanking? I mean, it's the one question that keeps most investors up at night. But for the legendary investor Jim Rogers, a nasty bear market wasn't a problem. It was a huge opportunity. So let's get into his completely counterintuitive way of thinking, not just to survive, but to actually win big when it feels like the whole world is falling apart. Okay, so picture this. We're at a cocktail party in Manhattan, right in the middle of the 1970s. And the stock market, it's been an absolute disaster for years. The Dow Jones was basically stuck in the mud at the same level it was almost 20 years earlier. The move was just awful. And if you worked on Wall Street, well, everyone just assumed you were having the worst time of your life. So the hostess of the party finds out what Jim Rogers does for a living, and she gives him this look of pure pity. You know, oh, you poor thing. And you can't blame her. To anyone on the outside, Wall Street in the 70s looked like a total financial wasteland. But her assumption? It was about to get turned completely upside down. And this is the line that just stops the conversation in its tracks. Things are great, I'm short. I mean, what? That is not the answer anybody was expecting. It's confident, it's kind of baffling, and it gets us right to the heart of a really powerful and, yeah, often misunderstood investment strategy. Of course, the hostess had no idea what he was talking about. She just looked at him. He was not a tall guy and figured he was making some weird, self-deprecating joke about his height. But he wasn't talking about his stature. He was talking about his strategy. He was selling short. So what on earth does it mean to be short? Well, usually we think buy low, sell high. Short selling just flips that completely on its head. You're basically borrowing a stock that you think is way overvalued, you sell it immediately at its current high price, and then you just wait for the price to fall. And once it does, you buy it back cheap, return the shares you borrowed, and you get to pocket the difference. You're literally betting against a company, and in a bear market, that can be insanely profitable. But here's the thing. Being right, even being a genius, is not enough. As Jim Rogers learned the hard way, really early in his career, even the most brilliant idea can lead to absolute, total disaster if your timing is just a little bit off. This is the story of how to be a genius and go completely broke. Okay, so back in 1970, Rogers sees a market crash coming. He was dead right. He bought some options and boom, tripled his money. He was feeling invincible, right? So he takes all of that money and goes short on a bunch of companies, thinking the market is going to fall even more. But it didn't. The market suddenly rallied, and because he didn't have enough cash to cover his bets as the stocks went up, his broker made him sell everything. He lost it all, wiped out. And this brings us to one of the most important lessons in all of investing. I mean, listen to this. You can be 100% right about something, but if you don't have the money to wait for the market to finally agree with you, it doesn't matter one bit. Being right too early is basically the exact same thing as being wrong. Now, here's the crazy part, the ultimate irony. Within just a few years, every single one of those companies he bet against did go bankrupt. His research was perfect. He was a visionary who saw it all coming, and he was also flat broke. You know, you'd think the lesson here would be don't fail, but Rogers takes away something totally different. He says failure is actually an essential part of your education. It teaches you humility, it forces you to respect just how crazy the market can be. And really, isn't it better to learn that lesson when you're 25 and lose $20,000 than when you're 55 and lose $20 million? So what do you do with a lesson that painful? Well, you don't quit. You use it to build a much better philosophy. One that isn't just about being the smartest person in the room, but about having a totally different kind of advantage. This is it, right? This is the million-dollar question every single investor asks. Do you follow the hot tips? Do you listen to the experts on TV? Rogers' answer is a hard no to all of that. The real answer, he says, is actually way closer to home than you think. His whole point is that your best investment ideas shouldn't come from some guru. They should come from your own life. Just look at what you're passionate about. What do you know more about than pretty much anyone else? Are you obsessed with cars or fashion or maybe the latest tech? That deep personal knowledge you have is a massive advantage that no analyst on Wall Street can ever replicate. So here's how it works in practice. First, you stick to what you deeply, truly know and love. Because you're obsessed, you're going to spot huge changes in that industry way before anyone else. And you learn to think around corners, meaning you don't just see the immediate effect of something, you see the ripple effects, what's going to happen next and after that. That's the knowledge that tells you not only when to buy, but maybe even more importantly, when it's time to sell. And this is just a brilliant way to put it because it gets to the most critical part of the whole strategy, patience. Most of the time, the best thing to do is nothing. You don't chase every hot new thing. You do your research, you watch, you wait, and you wait until an opportunity is so obvious, so undervalued, that it literally feels like you're just walking over to the corner of the room and picking up a big pile of cash that someone else just left there. So this way of thinking isn't just about what you know, it's really about who you are. It takes a special kind of discipline, the discipline to stand apart from the crowd and actually trust your own work. Let's just compare the two paths here. The crowd, the conventional wisdom, tells you to diversify, right? Spread your money out to be safe. Rogers says, no, the way you get truly wealthy is to do the opposite. Find a handful of brilliant ideas and concentrate your money there. The crowd is trading all the time, in and out. The contrarian does nothing most of the time. The crowd follows tips. The contrarian only trusts their own deep personal research. Here's a huge psychological trap you have to watch out for. When the entire market is going up in a bull market, everybody feels like a genius. It's so easy to think your big wins are because you're brilliant, and not just because a rising tide is lifting all the boats. And that feeling, that overconfidence, is unbelievably dangerous. And here's the key thing to remember from all this. The moment you feel smartest, right after a huge win, that is precisely when you are most likely to make a terrible mistake. You're feeling high from the win. You're eager to do it again. Rogers says that is the exact moment you need to step away from the keyboard, go to the beach, and do absolutely nothing until a truly great opportunity shows up again. At the end of the day, there's no single magic formula here. A fast-paced trading style might work for one person, and a slow buy-and-hold for decades approach works for someone else. The goal isn't to perfectly copy Jim Rogers or Warren Buffett. It's to figure yourself out and then build a method that actually fits your knowledge, your passions, and your personality. So how do we pull all of these lessons together? Well, it all comes down to a really fundamental shift in how you even think about investing. It's not a game of luck. It's an act of extreme, careful, deliberate thought. Rogers has this amazing thought experiment. Imagine you got a punch card, and on that card are only 25 slots. That's it. That's every single investment you're allowed to make in your entire lifetime. You wouldn't waste a single one of those punches on some random hot tip, would you? No way. You would research every single decision with incredible care. You'd wait for near-perfect certainty. That, he says, is how you should always be investing. Rogers loves this quote from an ancient Roman statesman, and you can see why. It's just a powerful reminder that your financial future isn't in the hands of some broker or a guy yelling on TV. It's in your hands. You're the one who has to build it, based on what you uniquely know about the world. And so we're going to end with this question, which really gets to the heart of this entire philosophy. Your greatest investing advantage isn't some complex algorithm or secret inside information. It's hiding in plain sight. It's in your hobbies, your job, your passions. Find that, and you've found your own way to build a fortune.
All right, today we are diving deep into the mind of a true maverick, a real original in the world of finance, Jim Rogers. We're going to unpack the core philosophy of this legendary investor and really focus on his unconventional boots-on-the-ground style that just consistently flew in the face of Wall Street's so-called wisdom.
So to really get who this guy is, it all kicks off with this amazing story. Picture it. It's 1969. Rogers is a young buck on Wall Street, and he hears about this little music festival happening upstate. Now, while everyone else is glued to their desks, he thinks, you know what? I'm going to hop on my motorcycle and go check this thing out. And right there, you see his whole philosophy in a nutshell. He didn't have a ticket. The cops had roadblocks everywhere. So what does he do? He drives through people's backyards, gets a flat tire, fixes it, and just keeps going. Then he spots some security guard jackets hanging on a fence, grabs one, and suddenly, he's got the best seat in the house, on stage for the entire festival.
And this is where it gets really telling. He gets back to the office on Monday, all excited, mentions he was at Woodstock, and his colleagues just look at him in horror. To them, it was just dirty hippies and chaos. To him, it was an experience. And that moment, right there, was a huge sign of a career that would be built on zigging while everyone else zagged.
Okay, so how did this contrarian streak, this willingness to go against the grain, actually play out in his professional life? Well, it all started with a pretty deep suspicion of traditional institutions, especially academia.
I mean, you gotta love this. This is just classic Jim Rogers. The dean of Columbia Business School asks him to teach a class. Rogers, who was convinced he learned more in one summer on a trading desk than in 2 years of business school, at first says no way. But then, he remembers Columbia has a fantastic gym. So, his counteroffer? He'll teach for free if they give him lifetime gym access. And you know what? They said yes.
But look, his skepticism wasn't just some funny quirk. It was based on a real critique of the system's value. He looked at the insane skyrocketing costs of these elite schools and basically saw a bubble. He argued they weren't really selling a better education anymore. They were just selling an extremely expensive brand name.
And the thing that really got under his skin was the whole idea of tenure. For him, it wasn't about protecting academic freedom. He saw it as a system that completely shielded professors from the real-world consequences of their performance, something that just doesn't exist in any other high-stakes job.
So to boil it all down, his view was that these places were becoming super fragile financially. You had academics, not business people running them. Their giant endowments were filled with assets that might not be worth what they claimed, and the whole thing was built on this brand name that was becoming unaffordable for almost everyone.
And here is the proof in the pudding. While he was teaching at Columbia, Rogers was very publicly predicting a huge stock market crash was coming. There was another professor, a tenured guy with a PhD, who told his students that Rogers was a fool. Well, on October 19, 1987, which happened to be Rogers' birthday, the market had the largest one-day collapse in history. Rogers, who had shorted the market, had a pretty great birthday. The other professor? Well, not so much.
So, if the classroom wasn't where you find real knowledge, then where is it? For Jim Rogers, the answer was actually pretty simple. It's the world itself. He was convinced that the best analysis doesn't come from a textbook. It comes from direct, unfiltered, personal experience.
And he put this idea into practice in the most extreme way you can possibly imagine. In 1990, he and his girlfriend set off on a motorcycle trip that ended up in the Guinness Book of World Records. We are talking 22 months on the road, 100,000 miles across 6 continents. This was not a vacation. This was his research department.
And the big lesson he learned from all this? It was one simple rule. Official sources, like government ministers and official reports, will always give you the polished, good news story. But the truth, the real story is in the details you see for yourself, at the border crossings, on the back roads, and in the black markets. And it was on these travels that he developed this brilliant, simple tool for taking a country's economic temperature almost instantly. He called it the black market thermometer.
It's a really simple concept. All you do is compare the government's official value for its currency to what real people are actually willing to pay for it on the street. That gap, the difference between those two numbers, that tells you everything you need to know.
So here's how you actually do it. First, you just watch how the border works. Is it smooth and efficient, or is it total chaos with officials asking for bribes? Then you change a tiny bit of money officially, just to get some clean bills and see what the government claims the rate is. Next, you go find the black market, or more likely it finds you. And finally, you just compare the rates. If there's a huge difference, you know the official story is a total fantasy.
And his analogy for it is just perfect. He said, a big, active black market with a huge premium on hard currency, it's like a high fever. You might not know the exact disease yet, but you know for an absolute fact that the patient is sick. It is an undeniable signal that something is seriously wrong with that economy.
Okay, so let's see how all of this comes together. The contrarian thinking, the on-the-ground research, the black market thermometer, it all converged in one of his most legendary investments. And the story starts, as you might guess, at a border crossing in Africa.
So after motorcycling all the way down through Central Africa and seeing nothing but corruption and chaos at border after border, he finally arrives at the border of Botswana, and he said it was like entering a different universe. The officials were efficient, nobody asked for a bribe, there was no black market for the currency, the roads were good, and the shops looked like they could be in any small town in America. It was completely different.
Right away, Rogers knew this place was an exception. All the signals he'd trained himself to look for were practically screaming that something here was different, that something was actually working. So, the big question is, what do you do when you stumble upon that kind of information?
He didn't just buy a stock. He immediately started wiring money and bought every single share of every single company listed on the Botswana Stock Exchange. A truly audacious move based entirely on what he saw with his own 2 eyes.
Now, before you get this image in your head of him being some tycoon buying up an entire nation's economy, there's a pretty funny punchline. At that time, there were only 7, that's right, 7 companies listed on the entire exchange. It's a great little detail that shows this wasn't about having a ton of money, it was about having sharp eyes and the guts to act.
And guess what? His gut feeling was dead right. As Botswana continued to grow and prosper, so did his investment. He held those stocks for nearly 2 decades, reinvesting his dividends along the way, and the results were absolutely spectacular. It was the ultimate proof of his method. Trust what you see on the ground, not what you're told in an office.
When you look back, Jim Rogers' whole career is really just a powerful lesson in independent thought and firsthand experience. And it kind of leaves us with a challenge, doesn't it? If the most valuable information isn't in the official reports or on the news, then what important truths are just waiting for you, right outside your own front door?
Hey, welcome. Today, we're jumping into the absolutely wild story of investor Jim Rogers. It's a tale of adventure, of thinking completely differently, and of making a massive bet that flew right in the face of Wall Street. So,
Just picture this for a second. You've been on the road for 3 straight years. You're wrapping up a trip around the entire planet, and some stranger just walks up, looks at your dusty, one-of-a-kind car, and says, "You're living everyone's dream." It's just perfect. It totally captures the magic of what Jim Rogers and his wife, Paige Parker, pulled off. But here's the thing. The dream they were living was way, way bigger than anyone could see from the outside.
You see, this is really a story of 2 journeys happening at the same time. The first was a physical one, right? An epic, globe-spanning adventure. But the second, that was a financial odyssey that started before the car even turned on. It was a bet so completely out of sync with the times that it was either total madness or pure genius.
First, let's just take a second to absorb the sheer scale of this road trip. I mean, come on. Kicking off in 1999, Rogers and Parker, through jungles, deserts, you name it, even war zones, they hit 116 countries in 3 years and set a Guinness World Record. This was no vacation. This was a full-on immersion into what the world really looked like at the turn of the millennium.
Okay, but while Rogers was gearing up for this incredible drive, he was also making a huge play with his money, a bet that went against everything Wall Street believed in the late 90s. And this slide really nails the contrast. In 1998, you have to remember, Wall Street was in an absolute frenzy over dot-com stocks. I mean, everyone was chasing the tech boom, but Jim Rogers, he was looking in the complete opposite direction. He saw that commodities, the raw materials, the boring stuff like oil, cotton, and sugar, had been in a massive slump for almost 20 years, and he was convinced a huge reversal was coming.
And this quote? This was his core belief. See, for 2 decades, commodity prices were so low that nobody wanted to produce more. Mines were closing, farmers weren't planting. Rogers knew that sooner or later, that lack of supply was going to slam into demand and prices would have to skyrocket. Then, those high prices would make people produce more, and the whole cycle would start over. He was just betting on a fundamental law of economics.
So he decides to go all in on commodities. But there is a catch. How in the world do you manage a complex portfolio when you're driving through the middle of the Sahara Desert? He needed a simple set-it-and-forget-it solution, but one didn't really exist.
And that's a perfectly fair question, right? There were a few commodity indexes out there already. So why go through all the trouble of building a brand new one from scratch just for his own money?
Well, when he popped the hood on the existing ones, he found they were all a mess. The Goldman Index was basically just an energy fund. The Dow Jones one gave more weight to aluminum than to wheat, which for the global economy makes absolutely no sense. And all of them, every single one, was geographically short-sighted. They only focused on the US and London. They just weren't going to cut it.
So what does he do? He builds his own, the Rogers International Commodity Index, or RICI. And his timing? Well, in his own words, it was astonishing. He launched it in August 1998, almost to the exact day that the 20-year slump in commodities finally hit rock bottom. And right after that, the new bull market he predicted started to roar.
So, what was the result of that huge bet? Well, by August 2012, long after his trip was over, his index had delivered a total return of a mind-blowing 281%.
And this chart just shows you how incredibly powerful that contrarian vision was. During the same time the dot-com bubble imploded and the stock market just limped along, the boring stuff he invested in totally crushed the S&P 500. His bet didn't just pay off, it paid off big time.
Okay, so now let's talk about how these 2 journeys, the road trip and the investment, were actually deeply connected.
See, while all the Wall Street analysts were stuck staring at spreadsheets in New York City, Rogers was out there gathering intelligence with his own 2 eyes. He was seeing the world as it actually was, not how it was written up in some report. He called it his continuing education, and it gave him an edge that was just impossible to get from behind a desk.
And you can see that edge so clearly when you look at one of the biggest investment fads of the early 2000s, the whole idea of the BRIC countries.
So while Rogers is out there driving, this idea completely takes over Wall Street. An economist at Goldman Sachs comes up with this catchy acronym, BRIC, and predicts that Brazil, Russia, India, and China are about to become the new global economic powerhouses, and money just starts flooding into these markets.
But Rogers, who had actually driven through these countries, was extremely skeptical. He saw that the new money in Brazil and Russia was almost entirely because of the commodity boom, the very one he predicted. It wasn't built on strong fundamental economies. He also saw Russia's demographic crisis coming from a mile away. For him, China was the only real deal, something he'd been saying for more than a decade already.
But it was India where his boots-on-the-ground reality really collided with the Wall Street hype.
I love this anecdote. Another analyst, Stephen Roach, visits India for the first time and is just stunned that a 120-mile drive takes 5 hours. For Rogers, who had been driving all over the country for months, that wasn't a shock. That was just a normal Tuesday.
What Rogers saw was a country just choked by problems you could never find on a spreadsheet. He saw soul-crushing bureaucracy, infrastructure so terrible that food was literally rotting before it could get to market, and just awful government policies. The hype coming from analysts who never left their 5-star hotels just didn't match the reality he was seeing on the road.
And this was his final razor-sharp conclusion on the whole thing. Of the 4 countries Wall Street was going crazy for, only one, China, was actually the real deal. The whole brick theory was 75% wrong.
So when you put it all together, what's the big takeaway from Jim Rogers' incredible road trip and his equally gutsy financial bet?
It's this. Real insight doesn't come from following the crowd or just reading what everyone else is reading. His physical journey was the proof for his financial journey. By getting out there and actually seeing the world for himself, he understood things that the so-called experts, all trapped in their New York echo chamber, completely missed.
And that really leaves us with the final question to chew on. In a world where we are just drowning in data and expert opinions, Rogers' story is this powerful reminder of the value of just thinking for yourself and getting direct experience. It really makes you wonder, doesn't it? What obvious truths that we all accept today are just waiting to fall apart if we bother to take a closer look for ourselves?
So let's dive into a fascinating story about what happens when a powerful professional conviction just completely collides with your most personal treasure. We're talking about the legendary investor, Jim Rogers, and a truly monumental decision he made about his dream home, a place he spent 30 years creating. Let's get into what led him to this incredible crossroads. And that's the big question here, right? I mean, imagine this. You find the perfect place, you spend 3 whole decades making it uniquely yours, only to stick a for sale sign out front? It sounds just unthinkable. But for Rogers, it somehow became the only logical choice. So what on earth could motivate a move that drastic? And believe me, this wasn't just any house. Rogers himself said it best. I doubt that I will ever find such a perfect place again. This quote really tells you everything you need to know about the emotional stakes. He knew exactly what he was giving up, which makes the decision he eventually made all the more compelling. Okay, so to really understand the weight of this choice, we have to go back, way back to the very beginning to see how he even found this incredible property and what made it just so special to him. So, picture this. The year is 1976. Jim Rogers is working on Wall Street, and he's living in an apartment on Riverside Drive in Manhattan. He's totally over apartment living and starts spending all his weekends on his motorcycle, just scouring the city and its outskirts for a real house to call his own. What's just amazing is the sheer luck of his find. I mean, his checklist was simple, but also nearly impossible to find in New York City: a house overlooking water or a house fronting open space. He never in a million years expected to find both. And then, one day, while he's just out bicycling, he stumbles upon an empty building, literally right next door to his apartment, that checked both boxes. Unbelievable. And get this wasn't just a house. It was this magnificent piece of history. It turned out to be a 10,000 square foot, 5-story mansion. It was actually a former Jesuit seminary owned by the Catholic Church. And even though it was empty, it was structurally solid. So he worked out a deal to buy the south house while a friend of his bought the north half. Just like that, the perfect place had been found. So now he has this enormous empty mansion. And, before he could even think about turning it into a home, it became a legend in its own right. This simple comment from a friend pretty much changed everything. I mean, Rogers had no furniture, just acres of empty space. So with a group of friends, we're talking journalists, a lawyer, a professor, they formed what they called the South House Crew and decided, hey, let's throw a party. The house went through this incredible transformation. For 6 straight years, it was the site of this iconic, almost Woodstock-like Mardi Gras ball. But by 1982, things started to shift, and Rogers began the long, painstaking process of renovation. He restored all the beautiful woodwork and turned it into his own personal home in the country, right there in Manhattan. It had everything: a rooftop hot tub, and what a food critic once called the only built-in barbecue they'd ever seen in the city. The house was perfect. Life was perfect. And then a whole new chapter began that would change every single one of his priorities. He became a father. This next chapter was really driven by this deep-seated feeling Rogers had carried with him his whole life. As an international investor, a world traveler, he constantly felt handicapped because he couldn't speak other languages fluently. He felt like he was missing out on opportunities, always seeing the world through an interpreter's lens, and he was absolutely determined that his children would not face that same disadvantage. This observation from his travels just perfectly illustrates his belief. He saw with his own eyes that being a native speaker commanded immediate respect and credibility, sometimes even more than expertise or status. It wasn't just about being okay at it. He was adamant that his kids had to speak a second language like a native. Now, this powerful conviction wasn't just some vague idea. It pointed him, with an investor's certainty, in one very, very specific direction. His logic was actually pretty simple. He traveled the whole globe, and he felt like he'd seen the future. If he thought Brazil was the next great power, he would have taught his kids Portuguese. But no, he was utterly convinced it was China. So if his children were going to have a massive advantage in the 21st century, they absolutely had to speak Mandarin. But trying to make this happen in New York, well, it proved to be impossible. The school only offered Mandarin for an hour a week. And what was worse, his daughter, Happy, was surrounded by English and Spanish speakers at the park. She started to feel like an outsider for speaking Chinese, and pretty soon she just declared she wanted to speak Spanish instead. You could just see the writing on the wall. And so, Rogers arrived at this incredibly difficult crossroads. On one side, he had his perfect, irreplaceable home, and on the other, he had this unshakable conviction about his children's future that he just couldn't ignore. He came to the conclusion that the only way for his children to become truly fluent was through total immersion. They had to be somewhere where they had no choice but to speak Mandarin to communicate. And so, he made the unthinkable decision. He put his dream home, his 30-year sanctuary, up for sale and began planning a move to Asia. He ends his story with this incredible moment of self-awareness. The man who once scoffed at parents uprooting their lives for their children was now doing the exact same thing. And it leaves us with a really powerful question. What convictions are strong enough to make you give up your own perfect world for the sake of someone else's future?
All right, today we're going to dive into a really provocative take on the 2008 financial crisis. Now, this is not your standard, dry textbook explanation. No, this is a first-hand account from an investor who basically says, "I told you so," and argues that the whole thing happened because the U.S. had become the largest debtor nation in history.
So here's the big question, right? Was the 2008 crash just some freak accident, a black swan that nobody could have predicted? Or were the warning signs there all along, just flashing red for anyone who was actually paying attention? Well, according to the investor we're talking about today, it was absolutely 100% predictable.
And to really get where he's coming from, we've got to start with his personal story. It's a great hook, because for him, this wasn't just some abstract economic theory. Oh no, this was a massive, high-stakes personal bet.
I mean, what a line, right? We sold at the peak. Just think about the guts, the conviction that takes. While his wife was literally begging him to stop going on TV and trashing the housing market, this investor, Jim Rogers, was quietly selling his own massive New York home. Why? Because he was absolutely convinced a crash was coming. And, well, he was right.
And look, this wasn't some lucky guess. He really put his money where his mouth was. He was actively betting against the market, shorting home-building stocks, and, this is key, Fannie Mae. And yeah, he was super public about all of it, which, as you can imagine, his wife was not too happy about.
So after making this incredibly successful bet, he developed a much broader and, frankly, way more controversial thesis, that the American economy as a whole was in a state of serious decline.
And he really paints this stark picture of two totally different worlds. See, he'd moved to Asia, and from that vantage point, he started describing America using these really jarring terms, like having third world airports and third world highways. And then he'd look at Asia and see a vibrant world just buzzing with excitement and energy. And a big part of that, as we're about to see, came down to savings.
And here's the actual quote that just hammers his point home. This isn't some vague feeling he has. It's a very specific, almost visceral comparison. He's basically saying the infrastructure you see when you fly into New York just can't hold a candle to the new, modern hubs in places like Shanghai or Singapore. For him, this was a physical, tangible sign of a much deeper economic problem.
And here's the hard data that backs up his observation. Just look at these numbers.
He points to America's national savings rate, which was hovering around 4%, sometimes even less. And then he compares that to China, with a rate over 30%, and Singapore, over 40%. His argument is pretty simple, really. You just can't build and maintain a dynamic, modern economy if nobody is saving and investing for the future.
So how in the world did this happen? Well, he argues that it's this huge, dramatic reversal of America's entire history in the global economy. Because, it wasn't always like this, not even close.
I mean, just look at this journey over time. Back in the 19th century, sure, America was a debtor nation, but it was borrowing money to build things, railroads, factories, the works. Then, after World War II, it flipped and became the world's biggest creditor. We were the bank. Even as recently as 1987, the U.S. was still a creditor nation. So this shift to becoming the world's largest debtor happened incredibly fast, and in his view, it's been an absolute catastrophe. And this brings us to a really crucial distinction he makes. Not all debt is created equal. That 19th century debt, he calls that productive debt. It was an investment. It built assets like railroads that would pay off for decades. But the debt today, he calls that consumptive debt. It's money spent on stuff that just gets used up or rusts away, creating absolutely no future value.
Okay, so if you're going to make an argument this strong, you need some villains, right? Well, in this story, there's a whole cast of them, and our author is not shy at all about pointing fingers and naming the specific people he believes led the country right off this cliff.
And man, he pulls no punches. He describes the people in charge both in Washington and on Wall Street not as some evil cabal of masterminds, but as a vast orchestra of incompetence. It's a key point. He doesn't think the crisis was caused by evil people, but by staggering, system-wide incompetence.
And who's the conductor of this orchestra? Well, in his eyes, it was none other than former Fed Chairman Alan Greenspan. This quote right here gets to the absolute heart of the criticism. The whole point of capitalism is that if you make bad decisions, you fail. But Greenspan's way, he says, was to just prop up failure again and again. He argues this basically broke capitalism by taking away the consequences for being reckless. And what about Ben Bernanke, who came after Greenspan? He sees him as just more of the same, a continuation of that same failed policy. He uses this now famous printing press quote to paint Bernanke as basically Greenspan Jr., someone whose only solution to any problem was to fire up the money printers, creating dollars out of thin air, and just fueling the next big bubble.
And the list just keeps going. You've got Hank Paulson, the ex-CEO of Goldman Sachs, who then becomes Treasury Secretary and, what do you know, bails out his old buddies on Wall Street. You've got Timothy Geithner, who's basically dismissed as a pushover who did whatever the big banks told him to do. And then there's President Bush, who, according to this account, just threw his hands up and gave up all responsibility for the whole mess.
Okay, so all of this blame, all of this criticism, it all boils down to one core economic idea. It's a concept that's supposed to be at the very heart of capitalism, but one he argues that our leaders have just completely forgotten about, or maybe just decided to ignore.
That concept is creative destruction. It was famously laid out by the economist Joseph Schumpeter. The idea is really simple. Capitalism is supposed to be this constant process of churn. New, better, more innovative businesses come along and replace the old, inefficient ones, right? Think about how smartphones totally wiped out the market for flip phones. It can be painful for some, for sure, but it's a totally necessary process for progress.
And to explain this, he uses this really powerful metaphor, a forest fire. He says that things like recessions and bankruptcies, they're like forest fires. Yeah, they're painful and destructive in the short term, but they're also absolutely essential. They burn away all the dead wood and the underbrush in the economy, which makes room for new, healthy things to grow back even stronger.
And this right here is the absolute knockout punch of his whole argument. By constantly stepping in to prop up failure, by stamping out every little forest fire in 1987, again in 1994, again in 1998, he says that Greenspan and the others just let all that dead wood and dry brush pile up for decades. So when the fire inevitably did start in 2008, it wasn't just a small, manageable fire. No, it was a raging, uncontrollable inferno that threatened to burn down the entire forest.
So when you look at it through this lens, the very people who thought they were saving the system were actually destroying its most important feature, its ability to heal itself. And that leaves us with a really tough question to chew on, doesn't it? If creative destruction is essential, what's the real long-term cost when we try to save everyone and everything from failure?
So here's a thought. What if, for capitalism to actually work, it needs its own version of hell? Today, we're diving into a really provocative idea that by trying to save our economy from its most painful part, which is failure, we might actually be destroying the whole thing. Let's get into it. And this quote right here, this is the whole idea in a nutshell. It comes from former astronaut Frank Borman, and it really frames the argument perfectly. The threat of total failure, of going bankrupt, is what keeps the system honest. It's the great disciplinarian. But if you take that away, sure, you might save a few companies now, but you risk condemning the entire system to a slow, grinding decline. To really get this, we've got to rewind to the 2008 financial crisis. The source material we're looking at argues that from day one, everyone completely misdiagnosed the problem. And when you get the diagnosis wrong, you're definitely going to prescribe the wrong medicine. This wasn't just some market crash. It was a symptom of a much, much deeper sickness. Okay, first things first, let's get our terms straight. The first possible diagnosis is a liquidity problem. Think of it this way. You've got a great job, you own valuable stuff, but your paycheck isn't for another week and your rent is due today. You just don't have the cash on hand right now. It's a temporary cash flow issue, that's it. But the second diagnosis, a solvency problem, well, that's a whole different beast. It's way more serious. This means that even if you sold everything you own, your house, your car, all of it, you still couldn't pay off your debts. You're basically broke. It's not about cash flow anymore. It's about whether you're financially sound at your very core. And this is where the treatment becomes absolutely crucial. A liquidity problem? Yeah, you can fix that with a short-term loan. No big deal. But trying to fix a solvency problem with a loan, that's like putting a Band-Aid on a compound fracture. Not only does it not work, it actually makes things a whole lot worse. And here it is, the central claim. The 2008 crisis wasn't just a temporary cash crunch. These massive institutions were sitting on mountains of toxic assets that were pretty much worthless. They were insolvent. But the people in charge treated it like a liquidity crisis and just flooded the system with newly printed money. They were essentially giving loans to the dead. The crisis didn't make these institutions insolvent. It just revealed that they already were. It's like that famous Warren Buffett quote, "You only find out who is swimming naked when the tide goes out." For years, a rising tide of easy money had been hiding a really ugly truth. When that tide went out in 2008, we all got to see who was on solid ground and who was, well, totally exposed. So what do you do when your country is facing this kind of total collapse? What are the options? Well, our source points to two real-world examples from the 1990s that showed two completely different paths you can take. It's kind of like a tale of two crises, each with a radically different outcome. So let's start with path number one, the path of denial. In the early 1990s, Japan's absolutely massive real estate and stock market bubble just popped. This pushed the entire country to a fork in the road, and the choice they made would end up casting this long, dark shadow over their economy for decades. Here's how it all went down. After the bubble burst in 1990, the Japanese government just refused to let its big institutions fail. They pumped tons of money into these insolvent companies and banks, basically keeping them on life support. This created a whole generation of what are called zombie companies, the walking dead of the corporate world. They just shuffled along, draining the economy without creating any real growth. And so the lost decade of the 90s just bled right into the 2000s, and suddenly you had two lost decades. And the cost of that decision was just staggering. Get this, more than 20 years after the crash, Japan's stock market was still down 75% from its peak. By trying to avoid the short-term pain of bankruptcy, Japan basically sentenced itself to a kind of long-term economic purgatory. But there was another way. Around the exact same time, Sweden was facing an almost identical crisis. A huge real estate bubble popped, and their entire financial system was right on the brink. But they chose a completely different path. Sweden decided to just face the pain. They resisted that temptation to do bailouts, and they let businesses and even individuals fail. And the result? A really brutal 2 to 3 year recession. It was tough. But on the other side of that pain, something pretty amazing happened. After clearing out all the bad debt from the system, Sweden's economy came roaring back, stronger than ever before. Today, it's one of the most stable economies in the world. I mean, the contrast couldn't be more clear, right? Sweden went through the fire of what's called creative destruction, and it came out stronger. Japan tried to avoid the flames and was just left with an economy full of zombies. The lesson here seems to be that a few years of really sharp pain can lead to decades of prosperity. So, which path did the United States choose after its own crisis back in 2008? Well, according to our source, the U.S. looked at the examples of Japan and Sweden and picked the wrong one. The argument is that the U.S. response was basically a carbon copy of what Japan did. We bailed out failed institutions, which rewarded the very incompetence that caused the crisis in the first place. The author even calls this welfare for the rich. By throwing good money after bad, we stifled that natural process of creative destruction, and we prevented the new dynamic growth that can only really come from the ashes of failure. Just to put this into perspective for you, before 2008, the U.S. Federal Reserve had about $800 billion on its balance sheet. In the years that followed, that number just ballooned to nearly 4 times its original size, all because the Fed was buying up toxic assets to save these insolvent banks. And someone, somewhere, eventually has to pay that bill. And this leads to the author's pretty chilling prediction. The Japanese talk of their 2 lost decades. We in America will have at least 2, possibly more. The argument is, by choosing the path of the zombie, we've basically condemned ourselves to the same fate. And maybe the most sobering warning of all is this. Back in 2008, the government was strong enough to bail out the system. But by taking on so much bad debt, its own financial health is now at risk. The next time a major crisis hits, the government might not have the resources, or frankly the credibility, to pull off another rescue. That safety net we all assume is there, it might not be. So it leaves us with this really challenging question. We're all taught to see failure as a bug, right? A problem that needs to be fixed. But what if it's not a bug at all? What if, as this argument suggests, failure is actually a necessary feature, the hell that keeps the whole system honest and ultimately healthy? It's a tough idea to swallow, and one that has some huge implications for our future. Thanks for tuning in.
You've probably heard of Jim Rogers, right? I mean, the guy's a legend. An American investor, co-founded the Quantum Fund, made an absolute fortune by spotting global trends way before anyone else. He's basically the poster child for the American success story. So here's the kicker. Why would a guy like that decide to leave America for good? That's the really fascinating question we're going to dig into today.
I mean, seriously, think about it. Why would someone who is the American dream just pack up and leave? It doesn't quite add up, does it? To really get it, we've got to follow him on his journey, his search for a new home. And what's wild is that this search, well, it ended up uncovering a really deep critique of the exact country that made him who he is.
Okay, so the whole thing kicked off with the birth of his first daughter, Happy. Rogers and his wife, they looked at the world and were just completely convinced that the future, it was happening in Asia. And they wanted their kids to be right in the middle of it. So their first thought? Shanghai. Rogers was certain it was going to be the next great city of the world, but, when they actually got there, they found out the reality on the ground. Yeah, it was a little different. Not so perfect.
And you can see just how seriously they took this. I mean, they made a whole list. Shanghai looked like the obvious winner at first, right? It was booming, a hub of finance and culture, but there was one massive problem. The air pollution was just awful. So they looked at Hong Kong. Super vibrant, really exciting, but same deal with the pollution. And then there was Singapore. Now, this was interesting. Ethnically Chinese, but English is an official language. And that right there was a total game changer.
So as they're weighing all these options, Singapore just keeps rising to the top. It quickly became the clear frontrunner. And it wasn't just about everyone speaking English. Turns out something he'd seen on a trip years before had planted this little seed in his mind, and it was just about to grow into a full-blown decision.
Get this. Years earlier, during a world tour, he went to a symphony at the Botanic Gardens in Singapore. And what struck him wasn't what he saw, but what he didn't see. There were no police, not a single one in sight. He knew instantly that if this were Central Park in New York, it would be crawling with cops. And that feeling, that powerful sense of just safety and order, that was exactly what he wanted for his family. And from there, the pros just kept piling up. Singapore, in his view, had the best education system in the world. Check. A top-tier healthcare system? Check. The infrastructure was absolutely flawless. And this was the big one. The public schools were bilingual. They taught in English, but his daughters would also become fluent in Mandarin. It was like the perfect mix of East and West.
And this rules are rules mindset really hit home when they tried to get their daughter into a top primary school. They show up to the parent meeting, and they're the only Caucasians there. They kind of thought, hey, maybe this will give us an edge. Nope. The principal laid it out crystal clear.
In Singapore, there are rules and everyone plays by them. No special treatment. They had to move to live within a kilometer of the school and put in volunteer hours, just like every single other parent. And honestly, that deep commitment to fairness just blew them away.
So you'd think that's the end of the story, right? Family's future in Singapore is all set happily ever after. But then, the fall of 2005 happens, right before his birthday, of all times. Roger's entire world just gets turned completely upside down. He got, and this is in his own words, accidentally dragged into someone else's criminal conspiracy. And this single event, this is what would cement his decision to leave the US for good.
Okay, to really get what happened next, we need a quick lesson on something called a segregated account. It's super simple, really. Think of it like a safe deposit box you have at a bank. Whatever you put in there, it's yours. It doesn't belong to the bank. So even if the bank goes bankrupt, your stuff is totally safe. For decades, this idea was like sacred in the futures industry, an unbreakable rule.
So here's how it all went so wrong so fast. In August 2005, this firm, Refco, gets hired to manage funds based on Rogers' commodity index. Fast forward to a Friday in October. A huge sum of money, $362 million, is moved from a secure account. The instructions were crystal clear. Put this into another secure, segregated account at Refco. But Refco, they didn't do that. They illegally dumped the money into a regular, unprotected account. And the timing? My gosh, the timing could not have been worse. Because that very next Monday morning, the news breaks. There's been a massive fraud at Refco. 1 week later, the company files for bankruptcy.
So just like that, the entire sum, we're talking $362 million of his investors' money, was gone, frozen, swallowed up by what was, at the time, the fourth largest bankruptcy in American history. And for Jim Rogers, believe it or not, the nightmare was only just getting started.
And this is where the story takes a turn that is just unbelievable. Remember, Rogers and his investors were the victims here. They were the ones who had their money stolen. And yet, lawyers, or as he calls them, ambulance chasers, started suing him. Can you believe that? They just sued everybody they could think of, hoping someone would pay them to go away, even though Rogers was clearly 100% a victim who had nothing to do with the fraud.
So this absolute personal nightmare of a legal battle, it really opened his eyes to what he saw as a deep, fundamental sickness in the American system. His focus started to shift away from just his own fight, and it became this much broader critique of what the United States had turned into.
And this quote, this really gets to the core of his whole argument. He believes this explosion of lawsuits in America is like a massive anchor dragging down the entire economy. It's hurting the country's ability to compete on the world stage. And he has a pretty powerful example to back it up.
Okay, just look at healthcare spending. In the US, it's over 17% of the entire national output. To put that in perspective, that's more than double the worldwide average. And Rogers argues that a huge chunk of that is because of something called defensive medicine. You know, when doctors order a bunch of extra unnecessary tests, not because you need them, but because they're terrified of getting sued later. And guess who pays for all that? We do. That cost gets passed on to every single one of us. So, what is it about the American legal system that makes it so, well, uniquely damaging? According to Rogers, it all boils down to a really simple but incredibly important difference in the rules of the game.
And when you see them side by side, the difference is pretty stark. In the United States, you can sue someone for basically nothing. It costs you next to nothing to file, and there's no financial risk if you lose. But in most of Europe, it's totally different. There, the loser has to pay the winner's legal bills. Think about that. That one simple rule changes the entire dynamic. It stops people from filing those crazy, frivolous lawsuits that just clog up the courts in America.
And what this creates is this really brutal strategy. The lawyers don't even have to win the case in court. All they have to do is drag it out, make the fight so unbelievably expensive and emotionally draining that you, the defendant, eventually just give up and pay them to make it stop. For Jim Rogers, this fight went on for 6 years. 6 years. He says the anxiety literally turned his hair gray. He called it all-devouring. And all of this leads to the really devastating conclusion of his entire argument. These massive litigation costs, they're basically a hidden tax on innovation. Think about it. Money that a company like BMW or Honda can spend on better engineering, an American company like GM has to spend on lawyers just to protect itself. And for Rogers, that is the #1 reason America's losing its competitive edge. So we're left with this big question, aren't we?
Jim Rogers' journey started out as a simple search for the best place to raise his kids, but it ended up as a diagnosis of what he sees as a uniquely American sickness. It really makes you stop and think, what is the real cost of a system where the fear of a lawsuit hangs over every single decision?
You know, countries rise and countries fall. It's a story as old as time, right? But what if the real secret to a nation's lasting success wasn't its army or its resources or even its politics, but its people? And maybe, just maybe, its willingness to welcome new ones.
I mean, it's the biggest question out there, isn't it? How do you build a society that's prosperous, stable, and dynamic, and actually lasts? It's a huge question, and the answers, well, they pop up in some pretty surprising places.
To find a really powerful clue, we're not going to look at some global superpower. Nope, we're heading to a tiny island nation, Singapore, a place that has, well, engineered a truly unique formula for success.
So how did Singapore pull it off? How do they create one of the most successful societies on Earth? Well, their strategy starts with something fundamental, giving every single citizen a real, tangible reason to invest in the country's future.
Get this, a staggering 88% of Singaporeans live in government-built public housing. The government figured out really early on that to build a stable society, you had to give people a literal stake in it. And we're not talking about just low-income housing here. This is a national system for pretty much everyone.
In that sense of investment, it goes way deeper. Singapore enforces one of the highest savings rates in the world, so employees have to put in 20% of their income and their employers add another 16%. That all goes into a national pension fund. You do the math, that's a combined 36% of a person's income getting saved and invested in their own future, their healthcare, and their home.
But, you know, this level of societal engineering, this intense focus on the long term, it creates its own tensions, especially when it comes to raising the next generation. And this brings us to a really personal debate about education.
This quote actually comes from the author Jim Rogers, an American guy who moved his whole family to Singapore. So imagine this, his daughter in first grade was getting 2 hours of homework every single day. As a parent, he was constantly wrestling with this question, is all this intense pressure a good thing, or is it just going to lead to total burnout down the road?
And this really highlights a fundamental philosophical difference. In the US, the source argues, there's this big focus on teaching kids self-esteem. But in Singapore, the whole culture is built around the idea that self-esteem is something you have to earn through hard work and actual achievement. It's a really profound split in how you prepare kids for the real world.
Now all of this, the housing, the savings, the intense education, it's all built on one inescapable reality for Singapore. It's an island. And an island, more than anything, needs people. I mean, the scale of Singapore's journey is just mind-blowing. 50 years ago, it was basically a swamp with 1 million people. Today, it's a global powerhouse with 5 million. That kind of staggering growth didn't just happen. It was built, from the very beginning, by immigrants.
And immigration isn't just some chapter in Singapore's history books, it is its present and its future. Just look at this breakdown. Today, nearly half of the entire population was born outside the country. This isn't an accident. It's a deliberate, calculated strategy for survival.
So why this desperate need for immigrants? Well, because Singapore is staring down a demographic cliff. Like a lot of developed nations, its population is aging fast, and it has one of the absolute lowest fertility rates on the planet. Without a constant flow of new people, the entire system they've built is at risk of falling apart. Immigrants aren't just a bonus, they are a flat-out necessity.
Okay, now let's flip the script and look at the complete opposite approach. What happens when a society decides to slam the door shut? For that, we're going to go from a thriving island in Southeast Asia all the way to the American state of Alabama.
So back in 2011, Alabama passed this law called HB 56. The source describes it as the most harsh, most draconian anti-immigration law in the U.S. at the time. The goal was pretty simple: drive undocumented immigrants out of the state. And you know what? It worked. But the consequences, they were absolutely catastrophic.
The first and most immediate blow was to agriculture. As immigrant workers fled the state terrified, entire crops were just left to rot in the fields. And just like that, the back of Alabama's $5.5 billion agricultural industry was broken.
Oh, but it didn't stop there. The state had just been slammed by these devastating tornadoes. But with a quarter of the construction workforce gone, poof, Overnight, rebuilding just ground to a halt. When you add it all up, the total estimated economic loss to the state was an unbelievable $11 billion. That's about 6% of Alabama's entire GDP. It was a completely self-inflicted economic wound.
And then you get the unintended, almost absurd consequences. A German executive from Mercedes-Benz and a Japanese manager from Honda were both detained under this new statute. All of a sudden, the huge international companies that Alabama had worked so hard to attract were watching their own people get arrested.
So when you contrast these two stories, Singapore and Alabama, it leads to a much bigger argument, one that really spans centuries. And the lesson from history? It seems to point in a very, very clear direction.
Think about it. Throughout history, which societies have been the most prosperous, the most dynamic, the ones that were open to the world? You had Cordoba around 1000 AD, a global center for science and philosophy. Or Samarkand in the 14th century, this thriving crossroads of culture. The source even argues that America's greatest period of prosperity was before the 1920s, back when its borders were essentially open.
But really, beyond all the economics and the history, this whole debate is about people. It's about drive, it's about ambition, and it's about what it takes to build something new. And that spirit is just perfectly captured in one final, powerful story.
The author remembers seeing this news report about a guy from Cuba. This man had strapped himself to a barrel and somehow, against all odds, navigated the treacherous Florida Straits to get to the United States. I mean, can you even imagine the ingenuity, the courage, the sheer desperation that takes? So when the man landed, police were waiting there to arrest him. But the author's reaction was the complete opposite. He thought, that person, the one who was brave enough and smart enough and driven enough to survive that insane journey, that is exactly the kind of person you want on your team, in your company, and in your country.
And that leaves us with one final thought. Maybe the whole debate over immigration isn't really about walls or laws or policies. Maybe the real question we should be asking ourselves is much simpler. What kind of people does it take to build a great nation?
So, what happens when the price of safety is freedom itself? That's the big question we're tackling today. We're going to dive into one author's really provocative argument, that in the race to keep America secure, the country is actually tearing down the very liberties it was built on.
The author we're looking at kicks things off with this really stark warning from Winston Churchill. And wow, that really sets the stage, doesn't it? The idea here is that locking someone up without a charge isn't just a minor injustice, it's the first step, the very bedrock of tyranny.
And that quote leads directly to the central, really challenging question of his whole argument. You know, after 9/11, we all heard that the terrorists hate our freedoms. But this author flips that around and asks something deeply uncomfortable. What if, in the process of fighting them, the government started to dismantle those exact same freedoms?
Okay, so to really get where he's coming from, we've got to hit rewind and go back to a core American principle. The author reminds us that the whole American experiment was founded on this really revolutionary idea. Your rights aren't a gift from the government. They're yours, period. The government's job is just to protect them.
This right here is the heart of it. The government was supposed to be a guardian of the rights you already have. But the author's whole point is that this relationship has been completely flipped on its head. Now, he argues, the state's own power comes first, and individual rights, they come a distant second.
So you might be asking, how did this massive shift happen? Well, the author points to one specific moment in time, the world after September 11th. He presents this period as the moment that fundamentally changed the balance between keeping the nation safe and protecting personal freedom.
And his Exhibit A for this is the Patriot Act. From his perspective, this one law, which was signed just 6 weeks after the attacks, basically stripped Americans of liberties they had taken for granted for over 200 years. He argues it created a new set of rules that looked a lot more like something from an authoritarian state.
In this slide, this lays out what that new reality looks like, according to the author. We're talking about things like warrantless wiretaps, indefinite detention, and these aren't just abstract ideas. His point is that these are the exact tools used by the very regimes America has always defined itself against.
But listen, the author argues this isn't just about surveillance and detention. He says it's happening in your wallet too. And he points to a law called FATCA as the perfect example of how our economic freedom is also being walled in.
So what on earth is FATCA? Well, to put it simply, it's a law that basically turns foreign banks into unwilling agents for the IRS.
They're now on the hook for identifying all their American clients and reporting a ton of detailed information back to the U.S. government.
From here, the author lays out what he sees as a totally predictable chain reaction. First, the U.S. government creates these super complex rules. Then, foreign banks realize that following them is expensive and incredibly risky. If they mess up, they can get hit with a massive 30% tax penalty. So, what's the easiest solution for them? Just stop doing business with Americans altogether.
And this has led to something truly wild. The author points to an advocacy group that's come up with a new name for American expats: toxic citizens. Just let that sink in. Not only are foreign banks dropping them, but get this, even some US-based banks are reportedly closing their accounts because the paperwork has just become an absolute nightmare.
And the end result of all this? Well, according to the author, if you're an American living in London and you want to take the huge step of giving up your U.S. citizenship, this is how long you have to wait just for an appointment: 6 months. He argues this isn't some theoretical issue, it's a sign that a real, growing number of people are heading for the exits.
I mean, the change he describes is just night and day. Not that long ago, he says, giving up your citizenship was apparently a simple walk-in process, and it didn't cost a dime. Now, it costs hundreds of dollars, you need an appointment, and you could be stuck on a waiting list for over a year. He presents this as clear as day evidence of a powerful new trend.
So now the author zooms out a bit. He suggests that what we're seeing isn't actually new at all. He connects these modern policies, the ones that are making it hard for money to move freely, to the disastrous protectionist policies that, in his view, made the Great Depression so much worse.
His take on history here is pretty fascinating. He claims it wasn't just the 1929 crash that caused the Great Depression, it was the political reaction to it, specifically a law called the Smoot-Hawley Tariff. He says this one law sparked a global trade war that turned what was a bad recession into a decade-long disaster.
And right here, he draws a direct line to today. Back in the 30s, the tariffs were called beggar thy neighbor policies, basically hurting other countries to try and help yourself. The author argues we're now seeing the 21st century version, beggar thy neighbor's currency. Instead of blocking goods, governments are blocking money from moving freely, and he says it's causing the same kind of damage.
This brings us to a really key idea: exchange controls. All this means are government rules designed to trap money inside a country's borders. And the author makes a critical point here. He claims that whenever these rules are introduced, they are always sold to the public as temporary measures for a crisis. But he warns that temporary can often end up lasting for decades, choking the economy the whole time.
So, how do you get the public on board with these controls? The author lays out what he calls the politician's playbook. When your economy is in trouble and the currency is tanking, you don't admit to mismanagement. Instead, you find a villain. You blame it on evil speculators, greedy bankers, or suspicious foreigners.
So, where is all of this going? In this final section, the author gives us his forecast for the U.S. economy. He argues that the same historical patterns he's been talking about are playing out right now with the U.S. dollar.
He points to what he calls a completely two-faced message from policymakers. At home, to the American people, the slogan is always, "We want a strong dollar." But when they talk to other countries, like China, he says the message is the total opposite. We need your currency to rise. And, well, basic math tells you that for their currency to go up, the U.S. dollar has to go down.
In the end, the author brings his entire argument full circle with this classic quote from Benjamin Franklin. And it really is the perfect summary of his whole point, that this trade-off between freedom and security is a false choice. The moment you start sacrificing your liberty for a little safety, you end up losing both.
And that leaves us right here, with this final, really provocative question. The author has laid out a historical pattern. When governments get into trouble, they eventually resort to trapping their own citizens' money. The chilling question he leaves us with is this: is he just giving us a history lesson, or is he describing America's future?
Ever wonder why governments always seem to run out of money? And, what happens when they do? Today, we are diving deep into one author's really provocative take on the history of money, the surprisingly predictable ways it all collapses, and what he thinks might be coming next.
So, this whole story kicks off with this really strange ambition. The author remembers telling his college buddies that while they all wanted to be president, his plan was, well, a little different. He wanted to be a gnome of Zurich. You heard that right, a gnome.
And that's the big question, isn't it? What on earth is a gnome of Zurich? And why would a young guy with basically no money want to become one? Well, the answer to that question is the key that unlocks this entire story about the very nature of money itself.
Okay, so to get this, we've got to rewind the clock to 1970, to a single decision the author made. It was a bet, really. A bet against the entire global financial system as it existed back then.
With what he calls pocket change, he literally walked into a Swiss bank in New York and insisted on opening an account in Swiss francs. He just had this powerful gut feeling that the whole system of locking currencies to the US dollar, which was itself locked to gold, was about to shatter.
So what's with the gnome thing? Well, the term was actually an insult. It was cooked up by a British politician who was furious at Swiss bankers for betting against the British pound. It was supposed to make you think of greedy little goblins counting their gold in a cave somewhere. But our guy, he wore it like a badge of honor.
So why would he make a bet like that? Well, to get it, you have to understand the world he was living in. This was the era of the Bretton Woods system, a time when the value of money was supposed to be totally fixed.
So here's the deal. After World War II, all the major world currencies were pegged to the US dollar, and the dollar was pegged to gold at 35 bucks an ounce. But this created some huge problems. For instance, Germany's currency was valued when its economy was in total ruins, but as the country rebuilt and started booming, its currency stayed artificially cheap.
And you could see the effects in the real world, because the German currency was basically on a permanent discount. German cars, VWs, Mercedes, BMWs, were dirt cheap for Americans. This let Germany build up these massive trade surpluses, while the US sank into a huge trade deficit. The pressure just kept building and building under the surface until the whole system finally just popped.
And this gets to the very heart of the problem. Fixed exchange rates don't actually prevent economic problems, they just hide them. It's like a pressure cooker with no release valve. The pressure just builds until you get a sudden, massive explosion. Floating rates, on the other hand, are the pressure release valve. They allow for all these small, gradual adjustments.
But here's the twist. The author argues that this isn't some new 20th century problem. This temptation for governments to play games with money is a pattern that goes back for millennia. To really get it, we need to go way, way back to ancient Rome.
This is actually where we get the word debase. The Roman Empire had a problem. Massive spending, but not enough silver. So what was their solution? You guessed it, they started cheating. They started with pure silver coins, but over the next couple of centuries, they kept mixing in cheaper junk metals until the coins were almost worthless. And, no surprise, anyone with half a brain started hoarding the real money, the gold.
And the author has this absolutely brilliant line to connect the past to the present. He says, when governments need money, they just create more. Whether it's adding lead to silver coins or firing up digital printing presses today, it's the same old trick. As he puts it, only the technology changes.
Okay, so this isn't just some dusty history lesson. The author points to two modern examples that show these exact same pressures at work: the supposedly safe haven Swiss franc and the super ambitious euro.
So, get this. The Swiss found themselves in a total trap. During recent financial crises, everybody rushed to the safety of the Swiss franc. But that made the franc so strong that it started crushing Swiss companies trying to sell stuff abroad. This left their central bank with two absolutely terrible options: fight the market and probably lose billions, or just print a ton of new francs and destroy the very reputation for safety that makes Switzerland a financial powerhouse.
Now the euro, that was built on a big, shiny promise to make sure it would be a rock-solid, stable currency. You know, like the old German Deutschmark. Every single member country signed the Maastricht Treaty. They all promised they wouldn't run a budget deficit of more than 3% a year.
So what happened when that rule got in the way? Well, the author points out that first, countries used some pretty creative accounting to get around it. Then, eventually, they just stopped pretending. He argues that the new generation of politicians simply cared more about winning the next election than about sticking to the rules. He has the perfect name for this kind of behavior: the Scarlett O'Hara theory of finance. It's all about kicking the can down the road, promising to deal with the debt tomorrow. But, of course, tomorrow never actually gets here.
Okay, so after taking us on a tour through 2,000 years of currency crises, from Rome all the way to Brussels, the author finally lands on a really provocative question with an even more provocative solution.
I mean, if history shows us anything, it's that politicians, no matter what era they're from, simply cannot resist the temptation to mess with the currency to pay for stuff. So, if that's true, what's the alternative? How do you even have sound money?
His solution is pretty radical, to be honest. Take the power away from governments. Period. Let the market decide what money is. He points out that all through history, people have used all kinds of things to trade, from gold and silver to cattle, seashells, even sugar.
And the logic here is actually super simple. If a government started, say, watering down its gold coins with lead, people would just stop using them. They'd switch over to whatever form of money they actually found trustworthy. The market itself would provide the discipline that politicians just don't have.
Which brings us full circle, right back to where we started. Back to that young man with a weird ambition and a small bank account. After all this history, in theory, did his personal bet against the system actually work out?
Oh yeah. Those Swiss francs he bought way back in 1970 have shot up in value by 400% since then. He points out that if he just kept his money in a U.S. savings account, it would have lost 80% of its value compared to the franc. His bet didn't just pay off, it paid off big time.
And that's where this whole story leaves us. It leaves us with a really powerful question. If the entire record of history shows that governments are, frankly, pretty bad at managing money, then who or what should we be trusting instead?
You know, there's an economic law out there that affects pretty much everything, from what you pay for groceries to the stability of entire countries. And here's the thing, it's so fundamental that no government, ever, has managed to successfully get rid of it. We all know that feel, right? You go to the store and the price of bread or milk has gone up again. It's frustrating. But what if I told you that anger might be a little misplaced? The material we're digging into today presents a really fascinating paradox about that exact feeling. Okay, so let's really unpack this idea. It sounds completely backward, doesn't it? How on earth could paying more for something be the reason we get it at all? Well, to figure that out, we have to look at the powerful economic law that's pulling the strings behind the scenes. And that brings us to the absolute core of why things cost what they do. The author's argument is that it's not really about greed or corporate villains. It's about simple, predictable human behavior. So here's the key takeaway. Price isn't just a number. It's a signal. A high price is basically shouting to every producer out there, hey, we need more of this, while a low price is just a quiet whisper saying, you know, maybe you should make something else. Just look at this simple choice a farmer has to make. If the government says you can only sell wheat for $3, but it costs $4 to grow it, well, why would you? You're just signing up to lose money. But if the market lets the price float up to $8, suddenly it's a great business. More farmers jump in. It's just common sense, really. Nobody is going to produce something at a loss. So you might be wondering, what happens when governments try to fight this, when they try to ignore this fundamental law? Well, history gives us some pretty stark examples that paint a very, very clear picture of failure. A classic example is the former Soviet Union. They set prices artificially low for everything, but in doing so, they completely killed any incentive for anyone to produce anything. The result? It became an everyday reality to see empty shelves and people waiting in line for hours hoping to get, well, pretty much whatever was available. And this quote just perfectly captures how absurd things got. Think about it. Kids in Russia literally kicking around loaves of bread because the government set price was so ridiculously low, it was actually cheaper than a real football. That's the kind of waste and bizarre inefficiency you get when you fight the laws of economics. And this wasn't just a Soviet problem. The same story plays out again and again all over the world. The Philippines capped rice prices, so farmers just stopped farming. Back in the 1890s, Germany banned wheat trading, and prices shot through the roof. Even in the US in the 1950s, when they banned a certain kind of trading on onions, onion prices doubled. The result is always the complete opposite of what the policymakers wanted. Okay, so this is where a simple economic principle escalates and becomes something much more serious. The author makes the case that messing with food prices doesn't just lead to empty shelves. It connects empty stomachs directly to angry citizens. Think about it. Most of us don't really notice the day-to-day price of copper or oil, but the price of food? That's different. It's immediate, it's personal, and it hits every single household every single day. And according to the author, that universal impact makes it a really powerful spark for social unrest. You can actually see the chain reaction here. It starts with a government trying to do something good, make food cheap. But that leads directly to shortages when producers give up. Those shortages then fuel public anger, and that anger can easily boil over into massive political instability. And here's a really stunning point from the text. Even protests that we remember for big political ideas, like the call for democracy in Tiananmen Square, often start with something much simpler: economic anger. It's often the high cost of living that's the real catalyst for getting people out onto the streets in the first place.
So, if trying to control prices often leads to disaster, is there another way? The author presents a really different model of governing, one that aims for stability by taking a completely different approach to the economy.
Now, to really get what the author is driving at here, you have to look at this key comparison they make. On one side, you have these 30-year dictatorships, regimes that tend to get stuck and stagnate. And on the other side, you have what the author calls China's model, which has put economic growth above almost everything else. This table really breaks down that contrast. The author describes these long-term dictatorships as being obsessed with the leader's personal wealth and just holding on to power, which usually leads to stagnation and makes them really fragile. In contrast, the argument goes, China's system, with its constant leadership turnover and intense focus on economic prosperity, has achieved something totally different, lifting hundreds of millions out of poverty and, so far, maintaining stability. And this brings us to this idea the author calls the Asian way. The core theory is pretty simple. You have to build economic stability first. The trade-off, of course, is that political freedoms often get put on the back burner, with this kind of promise that they'll be addressed later. The source points to places like South Korea and Taiwan as examples, former dictatorships that focused first on creating wealth for their people, which eventually did help pave the way for more political openness. So, after looking at all these historical examples, all these arguments about economics and how countries are run, where does all of this leave us? What's the big takeaway here? To put all this into a much larger perspective, the author brings in the ancient philosopher Plato. It's a reminder that this tension is absolutely nothing new. It's a timeless cycle. When people become prosperous, they demand more freedom. But sometimes that freedom can lead to chaos, which then makes people want a strong leader to come in and restore order. And so, in the end, we're left with this really profound and challenging question. It forces you to think about the incredibly complex trade-offs that shape our world. Do you need a stable economy before you can have freedom? Or is it the other way around? It seems like that debate, just like the law of supply and demand, is a permanent part of the human story. All right, we're diving into a really provocative idea today. The notion that the story we're all being told about the global economy is, well, just a story. The source material we're breaking down argues that a massive power shift is happening right under our noses, if we just know how to look for it. So where does this all start? It boils down to this one core belief from the author. You can't trust official economic data. It's not just a little off. It's basically seen as public relations. So forget the GDP reports and unemployment stats. The argument is that they're just a mirage. And this brings us right to the central conflict of this whole thesis: what the government tells you versus what you can actually see with your own two eyes. This slide really lays out the entire philosophy. On one side, you've got the official numbers, which are dismissed as unreliable, politically motivated spin that's always getting revised later anyway. And on the other side, you've got actual reality. You know, the stuff you can see and touch. Cranes in the sky, new factories, bustling ports. The message is simple: trust your eyes, not the press releases. So, if you follow that philosophy of trusting your eyes, where does it lead you? Well, according to this analysis, it leads you straight to China, which, it's argued, is winning the global game by just being better at capitalism. Yeah, see, this isn't your typical story about communism versus democracy. The source material says that old question from the Cold War, who lost China, is totally obsolete. The real question we should be asking now is how in the world did China end up owning so much stuff? And the answer, believe it or not, is by being phenomenal capitalists. And the genius of their strategy? It's just how simple it is. The author describes it as refreshingly direct. There are no political lectures, no strings attached about how you should run your country. They just show up with a checkbook, say, let's make a deal, and a deal gets done. It's pure business. And when you put the two approaches side by side, the difference is just stark. You have what the author calls the old Western playbook, taking things by force, paying less than they're worth, and telling people how they should live. And then you have the Chinese method, pay top dollar, make friends, and keep politics out of it. It's no wonder, the author claims, that this is winning them allies all over the world. So what's on their global shopping list? Pretty much everything. We're talking a massive spending spree on real, tangible assets. Oil fields, mines, farmland, you name it. And this isn't random. The argument is that it's a very calculated strategy to lock down resources for the long haul because they see global shortages coming down the line. Now, to really see this clash of global strategies in the wild, let's look at a perfect case study that the author brings up: Myanmar. To get why Myanmar is such a big deal, you have to know a little bit of its backstory. Believe it or not, this was once the richest country in Asia. Then it went through 50 years of total isolation. The author sees it now as being on the brink of this huge economic boom, kind of like China was right before it opened up in the late 70s, a country with tons of resources and a disciplined population ready to explode. But, and this is a huge but, the author points out that just as this incredible opportunity was opening up, American policy made it almost illegal for U.S. investors to even think about it. This quote really captures that frustration with sanctions that completely boxed Americans out of the game. So you gotta ask, right? If American companies were forced to sit on the sidelines, did that opportunity just disappear? Oh, not a chance. And here's your answer. Just about everyone else. China, India, Japan, all their neighbors, even Great Britain jumped in. They got to snap up all these incredible assets without any competition from the big American players. For them, it was an absolute field day. So the big takeaway here, according to the author, is that the sanctions didn't really do their job. Instead, the people who paid the real price were American businesses and workers, who were completely locked out of what could have been one of the biggest investment stories of the century. All right, so that's the here and now. Let's pivot and look at where the author predicts the next big economic shockwaves will come from: North Korea and a massive boom in tourism. The logic here is pretty simple. The argument is that North Korea's leaders aren't living in a bubble. Many of them have been educated or have worked abroad in places like Shanghai or Beijing. They've seen what a modern, thriving economy looks like. They go home, see a country that's a total disaster, and they know change isn't just an option, it's inevitable. Now, if or when that change happens, it could trigger an economic earthquake in the region. The author paints this picture of a unified Korea where you combine the North's huge pool of cheap, disciplined labor with the South's capital and technology. You'd suddenly have this 80 million person powerhouse that could completely outcompete Japan with its high costs and aging workforce. Okay, shifting gears from geopolitics, the author points to what might be the single biggest consumer trend for the next few decades. For the first time ever, huge numbers of Chinese citizens have two things: a passport and money to spend. This is about to unleash the biggest tourism boom the world has ever seen. To really wrap your head around the scale of this, let's just do a quick comparison. Think back to the 1980s, when the world was blown away by the sudden wave of Japanese tourists. At the time, Japan had a population of about 125 million people. Okay, now look at this number. China has over 1 billion more people. We're not talking about something that's just a little bit bigger. This is a whole different ballgame. So what does that mean? It's simple, really. You take the economic jolt from that Japanese tourism boom and you multiply it by 10, at least. That's the wave the author sees coming. And it's going to completely remake industries from hotels to airlines all across the globe. So we've covered a lot of ground here. Let's pull it all together and boil it down to the final core message of this whole contrarian viewpoint. You know, in the end, it all comes back to this. While most of the world is obsessing over established markets, the author argues that the real electrifying opportunities are in the places that are going through massive fundamental change, the places that are overlooked, misunderstood, or just starting to wake up. And that leaves us with one big question to chew on. If we stop listening to the official stories and start trusting our own eyes, is the real future of the global economy actually hiding right there in plain sight?
All right, today we're diving into an idea that's both powerful and, honestly, a little dangerous. The idea that for new things to rise, old things absolutely must fall. It's a concept called creative destruction. And we're going to see how it's used to explain not just why some companies win and others lose, but why entire nations rise and fall.
So, you want a hot investment tip? The author we're looking at today gets this question constantly. But you know what? He's not really thinking about next quarter's stock prices. His tip is way bigger than that. It's not about what to buy, it's about how you see the world.
Yeah, forget next week. He wants you to think about the next 100 years.
His so-called hot tip is really a new perspective, a powerful way of looking at history. It's about getting a handle on this deep, fundamental force that has been shaping civilizations for, well, forever.
And to really frame this big idea, he kicks things off with a quote from, of all people, a dying King Arthur. "The old order changeth, yielding place to new." The key takeaway here is that change isn't just something that happens, it has to happen. It's necessary. Because even the best systems, the best customs, can go bad if they stick around for too long. And that idea? That's the bedrock for everything we're about to get into.
Okay, so what is this big, powerful, unstoppable force we're talking about? Well, it has a name, and you really need to grasp this concept to understand the author's whole point of view. It's called creative destruction. The term comes from an economist named Joseph Schumpeter. He described it as this constant storm of innovation that just blows through the economy, right? It's always, and I mean always, destroying the old stuff to make room for the new. And here's the kicker. Schumpeter said this isn't some bug in the system of capitalism, it's the main feature. It's literally what it's all about.
And you see this play out all the time, right? Look at these examples. You had the horse and buggy, and then, bam, the automobile comes along and doesn't just make it better, it makes it totally obsolete. Or think about General Motors, an absolute giant getting knocked on its heels by a more efficient Toyota. Even how we relax changed. Reading by the fire gave way to television. It's just this relentless, non-stop cycle of replacement.
But here's where it gets really interesting. It's the human side of things. Our first instinct is always to hang on to what we know, to protect the old way. The author points out how politicians in towns will pour millions into trying to save a dying downtown, right? When really, they're just fighting the rise of the shopping mall. They're trying to resist this change instead of adapting. It's like trying to fight a law of nature, and it's a war you just can't win.
And all of this idea of fighting an unwinnable war, brings us to the author's main point. He takes this whole creative destruction idea and zooms out. He's not just looking at companies anymore. He's applying it to the entire United States. And his diagnosis? Well, let's just say it's pretty bleak.
To make his case, he points to one number. Just one. 50th. That's where the United States ranks in the world for life expectancy at birth. 50th. For him, that's Exhibit A. It's a huge red flag that even though the country spends an absolute fortune, especially on healthcare, the system just isn't working.
And he really drills down into four main problem areas where he sees this decline happening. You've got a failing education system, that super expensive but underperforming healthcare we just mentioned, a tax code he literally calls a nightmare, and this general sense that the country's innovative dominant edge is slowly fading.
Let's stick with that healthcare point for a second. Just look at these numbers. The U.S. spends a whopping 17% of its GNP on healthcare. That is literally double the worldwide average. And for all that money, you get 50th place in life expectancy. The results just don't add up. It's a perfect example, in his view, of a system that's both ridiculously expensive and doesn't work very well.
All right, now let's talk taxes. The author's take is that the whole system is completely backward. He says it's basically set up to encourage you to spend money and go into debt, while it penalizes you for saving and investing. Think about that. It's the exact opposite of what you'd think a successful country would want to do. Now, to be fair, he's not saying everything is doomed. He does see a couple of bright spots, like in agriculture and with all the new shale gas and oil. But, and this is a big but, he argues that even these huge, successful industries aren't nearly enough to stop the overall slide. So, okay, the diagnosis is in. The patient is sick. What's the cure? Well, this is where things get really wild. The author's proposed solutions are nothing short of radical, and even he admits they're probably never going to happen. And this question really nails it. If the whole system is broken, what do you do? Remember our theme, creative destruction. He's saying you can't just patch things up. For any kind of creative new beginning, you need some serious destruction of the old, broken parts first. So, what does that destruction look like? Well, here are his big ideas. Bring all the troops home from everywhere. Completely tear down and rebuild the legal and education systems. Throw out the old tax code and start over. And the big one, fundamentally change how the government itself even works. But why does he think these huge changes are so impossible? He's pretty blunt about it. In his own words, governments, including the one in the US, are just dominated and controlled by special interests. The system is so locked down by lobbyists and powerful groups that there's just no way to get the political momentum for real deep change. Which leads him to his most out-there ideas for fixing the government itself. Look at this. Step 1. Get rid of the income tax entirely. Replace it with a national sales tax. No more tax forms. Step 2. Bust up the DC bubble. Make representatives actually work from their home districts. And step 3, this is the craziest one. Draft representatives randomly, like for jury duty. You'd get a government of everyday people, not career politicians driven by ambition.
So after laying out all these big ideas he himself says are pretty much impossible, the author lands on his final and very sobering conclusion about what's next.
Yeah, he doesn't sugarcoat it at all. He's convinced that things have to get way, way worse, like hit rock bottom, before any real change can happen. And he says that's not going to be in our lifetime, or even our kids' lifetimes.
And to really put this in perspective, he puts the U.S. on this grand historical timeline. You see Rome, you see the British Empire. They rise, they peak, and they fall. His argument is that the United States is just following that same exact pattern, that it's already past its peak and is now on the way down. That the golden age, it's already in the rearview mirror.
And this leads to his final and frankly shocking prediction. He's not talking about a 10-year slump or a bad recession. He's talking on the scale of empires. He says that after we hit bottom, it might be 300 or 400 years before there's another rise to greatness.
So, that brings us right back to where we started, with this huge idea. The author's whole point is that this force, creative destruction, the same thing that got rid of the horse and buggy, is now working on a much, much bigger scale, on nations themselves. Which leaves us with a really big question to chew on. Is it an unstoppable force? Can any nation, no matter how powerful it seems, really escape this endless cycle of being created and then destroyed?